Adjusting entries are required in accounting because of the accrual basis of accounting. Under the accrual basis, revenue is recorded when they are earned, and expenses are recorded when they are incurred. Note that adjusting entries does not include the cash account. That is because when the adjusting entries are recorded, cash transaction has already taken place, or will take place in the future. In this screencast, I'll go through two scenarios that requires adjusting entries: deferred revenue and deferred expense. Deferred revenue refers to companies receiving cash before they earn the revenue by completing a service or delivering a good. Under the accrual basis of accounting, in the general entry, the cash inflow into the business must not be recorded as a revenue. Instead, it must be recorded as a liability. This is because the business has not earned the cash. For example, suppose a company was paid $1,000 on the 1st of October to complete a service on the 31st of October. The following journal entry will be recorded. As the business provides the service, an adjusting entry is required. The liability account is decreased and the related revenue account is increased. However, if the credit was wrongly recorded as revenue in the journal entry, then the adjusting entry would decrease revenue and increase liability by the opposite amount calculated. This shows the amount of revenue earned and the amount of money the business has yet to earn. Suppose the same company was paid $30,000 on the 1st of October to provide service for the next 3 months. If the company recorded the $30,000 as revenue originally, then at the end of the October month, the adjusting entry will look like this. On the other hand, deferred expense is where a company pays for a resource before they incurred an expense. As the resource has not been used, it cannot be recorded as an expense. Instead, an asset is recorded. As the asset is used, the asset account is adjusted down and the related expense account is adjusted up. For example, suppose a business purchased an insurance policy for 6 months on the 1st of January for $30,000. At the end of the month, should the company prepare a financial statement, then the following adjusting entry is required. If the purchase was incorrectly recorded as an expense, then the adjusting entry would increase the asset and reduce the expense account by the opposite amount to show the asset remaining an expense incurred.